Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching IndianOpen. Let's go straight to the headlines at this hour. US and China agree to a 90-day truce in the ongoing trade war, won't impose new tariffs on each other's goods while negotiating a lasting agreement. Back home, GDP growth in India moderated to 7.1% in the July to September period due to weaker consumption demand and a slowdown in the services sector. GST collections dropped below the 1 lakh crore mark once again. Tax collected was at 97,637 crores in November, lagging way behind the government's budget target. And auto sales were a mixed bag in November. M&M and Escorts reported robust sales while Maruti and Tata Motors saw a decline. Well, that may not have prompted the markets to start off on a weak footing because the world markets are looking reasonably okay. Firstly, the news, the trade war booster, frankly, the truce booster, if I can use that term. Both Trump and Xi Jinping, as the headline stated, agree to a temporary truce in a bid to contain the trade war. The fresh ammo for equity markets, frankly, which were anyways rallying post what seemed like a fairly dovish Fed. And I'm talking about the world markets right now, because if you look at what happened the whole of last week, and I'll come to our markets as well, but just look at this chart and it'll show you how the S&P 500 had its biggest weekly advance since 2011. That speaks volumes about the change in sentiment for the world markets and the US markets in particular last week. And this only adds further fuel to fire. You would expect a marginal reaction this later on in the evening or the early morning trades for the US markets as well. So the world markets are likely to stay positive, and that is likely to keep the markets by and large on a positive note. Look at what Asia is doing, for example. Nikkei is up about 1.25%. The Hang Seng about 2.5%, Shanghai 2.5%. Naturally, those markets will be impacted the most because the GDP growth gets a bit of a boost. It doesn't get lagged down. So Chinese markets will anyways do really well. SGX Nifty not quite rallying as much as the other world markets, but frankly, we've had a bit of a rally the last 5 days, haven't we? We've closed. Look at the trade setup. The Nifty's closed positively on each of the last 5 trading sessions. You could argue that Friday's trade was a bit muted, but nevertheless, the headline number was positive, and therefore 5 days on a trot, we've had a positive close in our markets. The broader markets showed a little bit of strength in Friday's session, which was after a really long time. And flows, while you could argue that FI sold off marginally in trade, they're largely positive. And what's aiding to this move is the kind of moves that we're seeing in the private banking space. Delivery-based buying continues out there, and just look at the deviation or the stark difference in the mood in the private sector space in November versus what's happened in the preceding 2 months. So the red bars or the red highlight is for what some of the private banks, the likes of HDFC Bank or IndusInd Bank or Kotak Bank, did in the preceding 2 months. And the uptick that we're seeing is what happened to these banks in the month of November. Northwards of 10% for each of these banks. In fact, HDFC as a financial name has gained almost 20% from the lows. So private banks and private financials are making a bit of a comeback, and that's essentially good news for our markets because these are heavyweights, to be honest. So what does all of this portend? That we'll have a good start in the trading day today. The question mark only is whether we can continue, because back home, for our markets, we've had 2 or 3 slightly iffy cues. The GST collection slightly lower, the GDP growth slightly lower than estimated, and the fact that crude has shown a bit of an uptick as well. So those 3 combined might just put a lid on the market, which has anyways gone up quite a bit in the run-up to this G20 summit. However, we'll get to know about it when we got to know about it. What about 9:10 or what about 9 or 9:15 when stocks will react? What are the stocks that are likely to do well or otherwise in trade today? Watch out for the aviation names: Indigo, Jet, SpiceJet, all of these. ATF prices for October have been cut by 11%. Pan-India for December have been cut pan-India by 11%, and that should augur well for the markets. So do watch out for these names. SEBI is likely to reopen the insider trading case against Sun Pharma. I heard the podcast this morning that was talking about how analysts believe that the discount that Sun Pharma has versus the peers could widen a bit. Let's see if Sun Pharma and Sun Pharma Advanced Research both tend to react negatively in the session today. Biocon could be in news. Fulfilia has been granted marketing authorization from the European Commission. It's a drug jointly developed with Mylan, but let's see if Biocon has some gains to the kind of gains that it already put up behind in Friday's session. So this should be an interesting one to monitor in the session today. Lastly, Ramakrishna Forgings. This should be interesting. Normally, Amansa's name would bring about a reaction and a negative one because they have sold out, but two interesting names have bought in. Abacus, which is Sunil Singhania's fund, has bought about 1.53% stake. Old Bridge Capital, which is Kenneth Andrade's fund, has acquired about 8 lakh shares or 2.46% at 515. So two interesting names getting into the stock. Let's wait and watch if this one has any kind of positive or negative reactions in the session today. Lastly, the sugar names, and I think the UP-based sugar companies, the Dhampurs, Balrampurs of the world, could be in focus because of the state-advised prices maintained in trade. And of course, as I said, do watch out for any kind of reactions later on in the day to the macros, the crude prices, the GDP numbers, or the GST collections being lower than otherwise estimated. So all these three factors could well prove to be a bit of a lid for our markets. However, let's tell you what's lined up on First Word today. The biggest news, what does the 90-day negotiation between the US and China entail? Eric Schnatzer will tell us what's on the table. Economists flag off expenditure side concerns, especially on consumption demand as growth slows down. We get a slice of that panel discussion. Carmakers find no festive cheer in November, while some commercial vehicle players hold ground. Yatin Mota will give us the fine print of the auto sales numbers thus far. And the management of Shankara Building Products warned of a further drop in margins. It's a stock that's gotten decimated. They held a con call. Somit Sarkar joins us to tell us about the con call highlights. Firstly, the big news. US and China have called a 90-day timeout in the trade war on the sidelines of the G20 summit. US President Donald Trump and his Chinese counterpart Xi Jinping agreed not to impose new tariffs on each other's goods during the period. The world's two largest economies will use this time to negotiate a lasting agreement. Bloomberg's Eric Schnatzer reports.
President Trump and President Xi found common ground at that dinner on Saturday night here in Buenos Aires. We can talk about a couple of the details. They are very important. The ceasefire, as it were, lasts for 90 days, so that takes us more or less until the end of February. The United States has agreed not to raise tariffs on some $200 billion of Chinese goods. They were set to go up to 25% on January the 1st. Instead, they're going to remain at 10%. And in exchange, and this is the big deal, the Chinese have agreed to do a number of things. First of all, they have agreed to start buying more American agricultural and industrial goods. They have agreed to take action on fentanyl. This is that high-powered opiate which has been the source of so many crises and heartbreaking situations in the United States and, of course, elsewhere. But most importantly, China now has 90 days to demonstrate that it's willing to how would I put it, to show some progress on the Trump administration's biggest beefs. What are those? It's not just the trade imbalance. It's the systematic theft of intellectual property. It's the coerced transfer of industrial technology. It's subsidies on state-owned enterprises, and it's cyber espionage. 90 days. It sounds like a long time, but it's a lot for the Chinese to demonstrate in short order.
Okay, well, let's get in our experts on and try and figure out what this means for the global markets. Michael Preiss, he's Executive Director, Client Investments at Taurus Wealth Advisors, joins us on the show. From our Singapore studios in a bit, we'll of course get in James Glassman, Managing Director and Head of Economics at Commercial Banking at JPMorgan Chase on the phone line from New York as well. But Michael, let me start off with you. What does this mean for world markets? Chinese markets, of course, have rallied. This is a bit of a booster to the economy, or at least not a negative for the economy. But what would this mean for markets at large, which are anyways rallying on the back of a dovish Fed?
Yeah, look, I think markets have been a little bit oversold. So what we are now seeing is a relief rally. The more important question is, because if you think about it, 2017 was very good for risk assets. 2018, so far, most markets around the world have been down with the exception of the US. In my opinion, what we could see is basically selling into strength instead of buying the dip. So again, I still hold the view that potentially in 2019 we see a sort of more global slowdown in economic growth that over time might actually feed into asset prices. So I expect more and more people to consider these bounces, these rallies, to sell into instead of buying them.
Glassman, as I said, also with us. James, good evening and thanks for staying up till late. What does this mean for the world markets? The same question actually that I asked Michael Preiss. What does this mean for world markets, which are anyways rallying on the back of a dovish Fed?
Yeah, I think it's constructive. I think actually the bigger news is what everybody expected. We thought that at the G20 meeting, President Xi, President Trump would try to dial down the tariff tensions. And I think the market's reaction to this tells you this has been the main obstruction to the equity markets and the mood most of this year. So I think, frankly, I think this is constructive. I think both sides realize this is not going, it was not going in the right direction. And I don't think there's a time frame here. I mean, they say 90 days, but I think as long as there's some effort to try to move forward so that we don't have to keep hearing about more tariff threats, this is a constructive development for the global economy.
So Michael Preiss makes an important point, James, and which is that 2019 has demons of its own. I'm using the terms demons, he didn't use it, but I'm just saying there are growth issues at hand for world markets at large, which is some distance out. In the near term, after the bit of a rally that we've seen for world markets at large and the US markets in particular last week, do you reckon that we can actually build on to the strength because of what's happened at G20, or will it be priced in a day's move at best?
A lot of it is priced in. I think even before the G20 meeting, people realized that this was not helpful, and we thought there's a pretty good idea that they were going to try to find some way to dial down the tension. But I think we could build more on this because, frankly, the global outlook is quite positive. Yes, growth is going to slow down because in the U.S., the stimulus that we've had a year ago, it's really pumped things up in 2018. But I think the U.S. economy is really got very low unemployment, so a slowdown would be very constructive. And in fact, we're not seeing the inflation threat that a lot of people are worried about, and I think that's why the Federal Reserve has taken a little more relaxed attitude about things. Where the closer we get to that ideal zone that they think, somewhere in the 2.5% to 3.5% range, the Fed is going to be more cautious, and I think that's been helpful. And frankly, we don't need the Fed or central banks to tell us they're going to be cautious when there is no inflation threats, and I think that's the key. So I don't worry much about a slowdown in 2019 because I think the world economy, the developed economies have done a good job largely recovering from the recessions. There's still more work to do, particularly in Europe. But I think this is really kind of a constructive environment. The inflation outlook is good. The financial health, the health of the financial system looks quite good, as the Fed chairman talked about last week. And those are two positive things to be constructive about for global markets, I think.
Michael Preiss, comment on that. If indeed a slowdown comes about, we'll figure it out. The point being, in the near term, the negatives, I'm looking at a market like India, for example, the negatives, which is higher crude prices, slightly more than expected hawkish Fed, as well as an imminent slowdown. All of these are out of the window right now, right? Because if indeed the trade war we have a truce and maybe some more truce is likely, then the global growth may not be as bad as otherwise would have been. Crude prices have come off, and the Fed looks a lot more dovish than otherwise.
Yeah, look, I mean, whether the Fed is really dovish needs to be seen, but I think what's very important is to understand that after many years of quantitative easing, we're now having an environment of quantitative tightening. So QT, I think in January, also the European Central Bank will actually net scale down asset purchases. So again, also in the US, we might have an interest rate hike on December the 20th. So I think liquidity is still tightening, and over time, the biggest driver for asset prices is liquidity, more than earnings. So liquidity is tightening, and that's why I think we also see more volatility. But longer term, again, as we've seen this year, markets potentially have more room to fall because of this tightening global liquidity. And that's also why I think emerging markets were a big underperformer this year, because of this tightening global liquidity. So if the ECB also starts to tighten in earnest, or basically tighten that liquidity, reduce that liquidity, I think we see more headwinds going into 2019. I think, again, many mainstream banks are still too optimistic about the outlook for 2019, in my view.
Okay, Michael Preiss, just one quick answer on India as well. We've come off quite a bit, but crude too has, and that's the big bugbear, which is not a risk right now. Any thoughts on India?
Yes. Yeah, look, I mean, India, I think, like emerging markets, increasingly at a level where it's prudent to potentially dabble in and buy some more, because I think it's also down to the dollar. If the dollar starts to weaken in 2019, I think emerging markets, and India in particular, can potentially rebound more. So yes, we are actually quite constructive on emerging markets, and especially India at this level.
That's great. James Glassman, Michael Preiss, gentlemen, both of you, thank you so much for taking the time out and being with us today on Bloomberg Quint India. Really appreciate your time. Well, those are two global voices speaking on the G20 summit. Maybe net positive for the markets, but a bit of a divided opinion there. Let's wait and watch. For now, we have a positive reaction across. Back home, the macro data, though, not the most positive. After peaking in the first quarter of the current financial year, growth in the economy moderated in the July to September period. Slowdown in consumption and the services sector can be attributed for the fall. GDP grew 7.1% in the second quarter, as against 6.3% in the same quarter last year, and 8.2% in the first quarter of the year. In GVA terms, the economy grew at 6.9% July to September quarter. This too was slower than the 8% GVA growth reported in the first quarter. More importantly, much lower than the Bloomberg estimates or the poll. Ira Dugal caught up with D.K. Joshi, Chief Economist at CRISIL, Soumyakanti Ghosh, Chief Economic Advisor at SBI, and former Chief Statistician Pranab Sen, and they all agree that the slowdown in demand is the cause for concern.
I think from the expenditure side, it is only private consumption slowdown, which is the bulk of GDP, that's responsible for the slowdown in the growth to 7.1%. The government consumption expenditure, private overall investments, and exports, I think they've all accelerated. The growth rates are higher than they were in the first quarter. So that's the expenditure side of the story. I think from the supply side, if we see, the drag is coming from services. I think the non-service part of the economy is doing reasonably well. The services, which used to be the driver, they have slowed down, and I think this slowdown has been, this is the third quarter they're showing below trend and very weak growth rate. The finance, real estate, trade, I think these segments are not growing above, perceptibly above 6.5%. So they're all below 6.5%. I think this is what used to fire growth earlier. And some of the reasons are explainable. I think the financial sector, the slowdown, particularly the banking sector, is also getting reflected in GDP. Telecom sector gets into the other part, the communication part. So I think unless these start reviving, the decisive upward trend in GDP is some time away.
Mr. Ghosh, is that your broad analysis as well? And then I'll get into specifics.
See, I have broadly 3 points to make. The first is that the private final consumption expenditure had indeed slowed down significantly in second quarter. The constant prices, the year-on-year growth rate is around 7%, which is down from 8.6% in the last quarter. So that's point number one. The point number two is that if you actually look into core GVA, basically which excludes the agricultural sector and the public sector, the public administration, that has significantly slowed down to 6.6% from 8.6% last quarter. So that means there has been an overall demand slowdown. And the third thing is that the apparent distinction, the apparent contradictory growth rate of the agricultural sector and the non-agricultural sector now looks clearly visible. If I break down the GVA into non-agri GVA and agri GVA, the non-agri GVA has expanded at 13.4%, nominal non-agri GVA, and the agri GVA has actually now collapsed to 2.8%. And in fact, the agricultural GDP deflator, if I calculate it, that is now at negative. September is actually at -1%, which is for the first time till June 2017, the agricultural sector, the price deflator has turned negative. So this indicates that there is a significant element of rural distress which is happening, which is perhaps adding on to the overall sentiments. And apart from the factors which Joshi mentioned in terms of the service sector, I think this is also one of the factors which is dragging down the overall growth rate.
All right, those are great insights, Mr. Ghosh. Dr. Sen, I'm coming to you last so that we can get a slightly broader picture from you as always. What are you seeing in the growth rates that you've seen in the past few quarters and in this quarter? 8.2, while not an outlier, but clearly seemed like it was boosted at least by, a base, etc. Wasn't reflective of any dramatic strength in the economy which was lasting.
Well, there are a couple of things. The first is the base effect, of course, does certainly play a role. The base effect in the first quarter was strong and it's starting to wane. and it will continue to wane as we go forward. But that apart, I think there's a more fundamental economic story that needs to be told, which is that, consumption behavior is usually fairly predictable in the sense that even if there is a downward pressure on the growth in incomes of people, they do try and maintain the consumption behavior over time. But after a while, the pressure becomes too much and consumption tends to go down. If we are seeing the beginning of this downturn, then it can in fact be persistent. So that's something we're going to have to watch out. At the moment, it's only 1 quarter of data, but that's a very real danger.
Well, that's the GDP numbers. Let's say it provides a bit of a lid to the growth numbers today, to the market numbers today. Anyways, let's see what will happen. We'll get to know about it a bit later on. The third piece on First Word today, Carmakers. They had nothing much to write home about in November, with almost all of the players posting lower sales last month. In fact, Tata Motors also saw its commercial vehicle division see a dip in total sales. But the tractor numbers seemed a bit better if the podcast is to be believed today. Yatin Motado is here to take us through the details and tell us whether the numbers had a silver lining or were they a bit of a damp squib. Yatin.
So, Neeraj, it was expected that there will be general slowness given the fact that in the festive season segment or the period we saw, muted sales and the inventory got carried forward. So there was a good probability that this time the November sales would not be that great. But if you still look at it, slightly better to in line with expectations for the numbers which have come in, barring 1 or 2. So let's start with Maruti Suzuki, wherein the compact car segment, which is basically the Baleno and Swifts of the world, that segment grew 11%. Exports, however, have been weak for Maruti Suzuki. So we saw almost a 20% fall there coming in for them. So on an overall basis, then sales stood almost flat. To minus 2% as far as Maruti Suzuki is concerned. As far as Tata Motors is concerned, again, last time we told about the commercial vehicle segment as to how there is general slowdown coming in. Of course, the NBFC segment, which has not been able to finance or aggressively finance the commercial vehicle segment, the impact is clearly seen there. So 5% decline in Tata Motors commercial vehicle sales, and the passenger vehicle segment sales are also almost flat on a year-on-year basis. As far as Mahindra & Mahindra is concerned, we have the UV segment, which is boosted by the new Marazzo launch, because of which we can see some growth coming in. The commercial vehicle segment, not that great in terms of the overall contribution, but there also we saw a 26% kind of a growth. Tractors, interestingly, we have seen a 56% growth in the segment for Escorts. So good number coming in. In fact, we were expecting the numbers to be close to 5,500 units, and they have posted a number in excess of 7,500 units, which clearly means that there is strong growth as far as northern Indian markets are concerned for the tractor segment. As far as Hero MotoCorp is concerned, the numbers, the overall volume stood at over 6 lakh units, but slightly lower than the street expectations. The total sales growth coming in only 0.8% there. Also, we had Royal Enfield. They also disappointed with their numbers. We saw a decline coming in there as far as Royal Enfield sales are concerned. Of course, the commercial vehicle segment sales for Royal Enfield, or Eicher Motors rather, has been better than expectations, but clearly the Royal Enfield sales have disappointed, despite the fact that the Chennai plant strike has been off and there was some production improvement that we saw and the analysts forecasted.
Okay. We'll watch out for some of these auto names, Yatin. Thanks for putting that into perspective. Do watch out for the tractor makers. Maybe a slightly better than expected number. And let's see if that brings about a reaction on a good day for the markets. However, it may have been a good day for the markets or a good week last month, but it's not been a good year for Shankara Building Products, which witnessed a 70% drop in share prices. And the management made it clear at an analyst call that they are not going to focus on margins and stay focused on higher sales instead. Somit Sarkar is here with the key highlights of that conference call. 693, Somit. The stock's been on a bit of a pullback mode. What did the con call bring out?
So if you see in the conference call that they had held on Friday, they said two important things. First, that they will be focusing on being more competitive in the market, and the second will be that they'll be focusing more on cash sales over credit sales. Now they believe that being competitive would be the right strategy for the company over the long term, but that would come at the cost of margins for the company. Now they believe that keeping high margins would not be a sustainable strategy for the company, and that's the reason they are going forward with the strategy of being being price competitive. Now along with this, the company will also be focusing more on cash sales over credit sales. Now, focusing more on cash sales would bring down their working capital cycle, which would result into lower borrowings and a healthy balance sheet. But again, this strategy would also come at the cost of margins. Now, because of these new management initiatives to provide the best price, loyalty discounts and reducing credit sales would lower the company's retail segment's margin by at least 300 basis points in the financial year 2019 from what they were earning in financial year 2018, that is close to 10.7%. The company expects their FY19 retail segment EBITDA margins to be in the range of 6 to 8%. Also, the second business segment of the company, that is the channel and enterprise segment, that has also not been performing well because the company is not focusing much on this segment because it anyways provides a lower margins to the company. But also, if you see, this business segment has been hurt because of higher raw material prices and because of companies' inability to pass on this to the consumers, and so no good news on this segment also for the company.
But how does all of this impact the balance sheet? That's been a bit of a concern.
So I'll give you the impact on balance sheet and profit and loss account both. For if you see in the profit and loss account, because of this new management initiative, the consolidated EBITDA margin of the company, that is expected to be lower to around 4.5 to 5% in financial year 2019 as against 7% earned by the company last year, that is financial year 2018. Now this drop in margins would result into a 38% drop in their earnings per share in financial year 2019 compared to last year. Now this is according to our calculation. So if you see the numbers that you're seeing in the screen, we are showing two estimates. Now first is the Bloomberg estimate, which is the consensus of all the analysts that is tracked by Bloomberg. Now this was before the analyst conference call held on November 38. So back then analysts were anyways estimating the company's margins to be lower at around 6.2% and the EPS to be lower at around 31 rupees because of a poor performance seen in the first half of financial year 2019. But now given the new margin guidance of around 4.5 to 5%, the EBITDA of the company is expected to be further lower by around 19%, while the EPS is expected to be further lower by nearly 36% according to the data compiled by Bloomberg Quint. Now this is the impact on the profit and loss account that you are seeing right now. But on the balance sheet side, if you see, their working capital cycle is expected to improve because they are focusing more on cashes. Now the company's receivable days or the debtor days, now that is expected to be lower to around 25 days from 47 days in the first half of financial year 2019 and around 61 days in financial year 2018, which would lower its entire working capital cycle by around 22 days. So this is something positive that will happen on the balance sheet side because it will not only improve the company's short-term liquidity position but will also increase the business efficiencies. But on the P&L side, the impact is expected to be at least 200 basis points on a consolidated basis.
Just want to very quickly do a follow-up and get that plate up wherein we've shown the BQ estimates post the con call. How is it that the profit estimates go down to 46 versus the consensus estimate of 71?
So that is because the margins are expected to be lower. Now, analysts earlier were expecting a margins of around 6.2% in the financial year 2019, but the management is now saying that the margins would be in the range of around 4.5 to 5%, and because of this drop in the margins, their EPS and its net profit are expected to be lower at around those numbers.
Well, figure out at 20 rupees EPS expectations for FY19. The stock is trading northwards of 32, 33 times.
Close to.
Well, which is not cheap for a company which is not exactly in the growth mode right now. Let's wait and watch though. Samit, thanks for putting this into perspective. Really appreciate that. That Shankara Building Products. The con call happened sometime during market hours on Friday, but the entire details out right now. That brings us to the end of First Word today, but lots more lined up on Indian Open. We discuss the markets and macros and specific stocks with Mukul, Kochhar of Investec. He joins us at 9 a.m. The government mulls the merger of REC and PFC to plug the fiscal gap. We talked to REC chairman PV Ramesh about the proposed deal. But after this break, a full tilt towards the day's trade.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
भाइयों बहनों, केंद्र सरकार राज्य सरकार मिलकर के काम कर रहे हैं।
किसान है हिंदुस्तान का, उसको सही एमएसपी मिलेगी। मुझे बताइए सही दाम मिल रहा है आपको?
मैं पूछना चाहता हूं क्यों चुनाव आगे कराया?
My relationship with Mizoram is a family relationship. It's a relationship of love.
अभी तो सपने और बड़े हैं, मंजिल काफी ऊंची रखी हुई है, वहां तक हम सबको पहुंचना है।
Hello, welcome. You're watching IndianOpen right here on Bloomberg Queens. Let's quickly take a look at what's been happening in Asia. And, like we already took a check, it's been a sea of green out there post what came out from the G20 summit with the 90-day truce between the US and China. No further tariffs between this period. And the market's taking kindly to it. That excitement that you can see on the screen. Nikkei 225 is up 1.5%. Shanghai is up 2.5%, and so is the Hang Seng. For SGX Nifty, while the uptick is not to that great an extent, still a gap up opening is what you can expect, more than 0.5% on the SGX Nifty. Remember, last week's trade, which was the last week of the November series as well, was a particularly positive one, with every single day the Nifty ending in the green and fresh longs now building up for the next month's series. We've got Agam Vakil who's joining in right now to highlight what happened in the liquid space, in the futures and options space. Did the volume start picking up, and did we see more fresh longs now, Agam?
Well, actually, we saw mixed cues coming through last Friday. What we saw was, while the Nifty did advance by around 0.3%, there was very little change in open interest when it comes to your, general OI. So as you can see here, well, little less than 1% added, but we saw unwinding in the Nifty banking futures, where the OI declined by around 10%. So longs were unwound, but going in, when it comes to your WIX, that did rise by around 2.5% to around 19.2. And we're also taking a look at your open interest distribution, which stood at, max OI at around 10,500 put and the call at around 11,000. So that's the range that we're looking at. In terms of changes in open interest, we did see a lot of change in 10,700, 800 and 900 options. Moving in, we are also keeping an eye on the Nifty put call ratio, which didn't change too much, which is still at an elevated level of around 1.7, and the Nifty banking put call ratio at around 1.2. In terms of stocks, Oil India, of course, saw a lot of shorts building in, considering the drop in its underlying. On the other hand, Repco Home Finance saw a lot of longs building in, considering an 8.5% increase. And Siemens was the one where we saw a lot of short covering, considering a decline of 22% in its open interest on the very first day of the new series. So we're going to be tracking some of these developments. Mixed cues coming in, but all eyes will be on the index, whether or not we can see it move above the mark of 11,000 today.
All right, Agam, thanks very much for that. So those are a few stocks that you'll keep an eye out on. We've got with us Samir Kalra to run us through his view on the market. Samir, obviously the world markets right now looking that much more positive. We've got the 90-day ceasefire between the US and China. But already, as we've seen, the Nifty has made its big move last week. Does it have legs to take it further?
So I think if you see the global cues, it's more like sentiment positive kicking in. But if you see the domestic data, which has come out negative, so GDP is lower than expected by the private consumption. So that's a big dampener on the consumer demand or the consumer stocks, from my point of view. If you see the auto numbers, they are coming down slow. The bikes have flattened out. The passenger cars are coming off. If you see the total registrations are 20% down YOY for November. And even month on month, they are slightly up. So I think passengers and bikes will slow down further. Commercial vehicles are on the peak of it. So I think over there, if these kind of demands take off on the downside, I think we have a downside coming in.
What did you make of the auto sales numbers? Any stock that works for you based on those numbers?
Not really, because if you see...
sorry, make your point first.
If you see the escorts and the tractors make it two-way benefits. One is the festival season was there. Second, the crop season hits up. So over there are these preemptive buying which happens. And the financing wasn't that much of issue on the tractor side, as per our channel checks. The issue came on CV side, which you saw in Tata Motors numbers, specifically if you see the MHCV side. So over there, the upgradation is happening on a bigger axle. So bigger load is getting. So the volume will definitely today or tomorrow will come out drastically. So over there, that's kind of a dampener. And for them, the main cargo is the passenger cars. And the two-wheelers, they drive from the yard to the production unit. So that is the main benefit for the fleet operator to keep on buying the MHCV. And if they see a slowdown over there, then automatically the slowdown hits the CV. Okay. So I think it's more negative. December will be any which way more negative for the consumer side of it.
So you're not even sanguine on the tractor space, the likes of escorts or maybe even...
I would like to see the December numbers before I take a call on whether it's sustainable or not.
Okay, that's in the auto space. Yes Bank for one, Friday session, so an interesting comeback from being the worst performer. Though you can't take away from the thrashing it's got in the entire series of November, one of the worst performers. I think lost out about 25 odd %, but 6% higher, 170 odd. Do things look like they could see? Obviously, we'll be looking out for the December 13th meeting, what comes out of there. But what would you be watching out for, particularly to Yes Bank, and whether or not at these valuations they do make an interesting play?
So we had to talk on your show only last week, and we were looking for a further downside. It came and it went back from there. So I think.
And you said you were not accumulating at that point.
So the weight is still the same. I still see a bit of downside. 13 might give it anticipation that the name will come up and everything. So these positive cues might bring it up to 190, 200 somewhere. But I think that 160, 170 will be seen once the news is out and again that simple mathematics comes out. I'm more interested in looking on the January release of the numbers, of the October to December numbers. Because over there, if the numbers stabilize or they don't deteriorate further, I'll be more interested in buying then. I'll not buy and take a risk on right now.
All right, that's Yes Bank, 170 already. Last 1 month, the stock's given up about 18%.
Yep. Let's see if there's more in store today. Actually, the private banks, they've been by and large. We just had this Bloomberg chart up earlier in the day. The kind of moves that the HDFCs and the HDFC Bank and even an IndianOpen Bank or a Kotak have done. November has been a stark reversal from the losses that they'd seen in the preceding 2 months. So private banks certainly right up there. Look at that. 1 month returns for HDFC Bank, 9%. A Kotak Bank would be similar. Yeah, about 9%. HDFC would be a lot higher. So the high weightage private financials are certainly making their mark felt. HDFC in particular has had a stellar run.
ICICI Bank is of interest as well right now. What would you do with that one?
So I would lay off because it has had a run up from the name disclosure to the takeover and the switching of things. And I'll give the new management a couple of quarters and see how they react to the provisioning part or the acceleration on the recovery part. So I think I'll take a commentary for next quarter or two and then see how things work out for them.
Okay, stay on. So much more to speak about, Samir, but let's talk about some of the stocks in news and some stocks that are likely to react this morning. We, of course, gave you a bit of a heads up on the auto sales. What else is in store? Sumit, Yash, as well as Agam here to talk about those. And let's start off with the stocks in news first, guys. Good morning to all of you.
Morning, Neeraj. I'll start with the stocks in news. So, firstly, aviation stocks would be in focus after ATF prices for the month of December have been cut by 11% due to tracking lower crude oil prices and a stronger rupee. Sandhar Technologies would also be in focus after the company said that it has signed a joint venture with South Korea's Kwangsong Corporation to make plastic products and accessories for cars and commercial vehicles in the country. Monte Carlo Fashion, watch out for that one as well, after the board of directors of the company have agreed to buy back close to 4.6% equity at a share price of 550 rupees a piece, which is at a 42% premium to its current market price. NMDC would be in focus after the company has cut iron ore prices by up to 8% in the month of December, according to a Steel Mint report. Also, the sugar millers, UP-based sugar millers, would be in focus after the UP government has maintained the SAP prices, which is the state advisory price of 315 rupees per quintal. And watch out for Sun Pharma as well, after there's a PTI report suggesting that market regulator SEBI will be reopening its insider trading case, and also they are hosting a con call at 6:30 p.m. today.
Very interesting. Thanks a lot for that, Yash. We'll watch out for the aviation companies in particular and maybe some of the sugar names as well. But Agam, some very interesting bulk deals as well.
Yes, actually, a lot actually. I'm going to start off with ICICI Lombard General, where we have Red Bloom Investments, and they've sold 2.9% stake in the company. On the other hand, RWC Global, Fidelity Funds and DSP BlackRock Mutual Funds have all bought stake in ICICI Lombard General Insurance. Ramkrishna Forgings is perhaps the more interesting one here, considering Amansa Holdings has sold equity worth 5.24%, and the buyers into this equity is Abacus Growth Fund, which has bought around 1.5% equity, Old Bridge Capital, which has bought in 2.5% equity, and we also have Vantage Equity Fund, which is bought in about 0.9% equity. So this one will be an interesting one to watch. Bharat Heavy Electricals Integrated Core Strategies acquires 0.8% equity in this company, and Repco Home Finance, again, very interesting one. Pabra Investment Funds sold around 1% equity at around 338 rupees per share. So a whole host of stocks to watch out for there on the back of deals.
Interesting. We will watch out for all of those. Some interesting brokerage notes as well, Samit.
Well, a couple of them. The first one is on the Indian tire industry, where Nomura has initiated coverage. Now, according to the brokerage, the industry fundamentals are in a better shape now with healthy demand and high utilization levels. Now, the brokerage believes that the Indian tire industry is a play on healthy growth outlook, pricing discipline and benign commodity prices, which will support the margins going forward for this sector. Now, most companies have already taken a price hike of around 6%, thereby passing on most of the commodity cost pressure, which is a key positive for the sector, according to the brokerage. Now, despite high capacity expansion plans that the tire industries have planned for, the utilization levels of the sector are expected to be high because of a strong demand scenario. Now, the brokerage has initiated coverage on 3 stocks, Apollo, CEAT and Balkrishna Industries. For Apollo, it's a buy rating with a target price of 288. For CEAT, it's a neutral rating with a target price of 1346, and for Balkrishna Industries, again, it's a neutral rating with a target price of 1008. Now, the second brokerage that we have is CLSA on Motherson Sumi. Now, the brokerage has maintained its outperform rating on the stock, but has cut down the target price on Motherson Sumi to 180 from 223. Now, according to the brokerage, the Indian business of the company is in a soft patch due to weakness seen in the PV demand and because of higher raw material prices. However, the brokerage outlook on the Indian business is positive going forward. When it comes to the international business, weak European auto demand has been hurt hurting the company's performance on the international side. But some of this has been offset because of the new plant ramp-up that we have seen recently. Lastly, to factor in these negatives and a weak second quarter, the brokerage has cut the FY19 and FY19 to FY21 EPS estimates of the company by around 7 to 14%, and it is expecting further downside to consensus estimates also.
Watch out for all of these names. Thanks a lot for that, Samit. Samir, couple of pockets. I don't know how closely you track sugar, but the UP-based sugar millers and the fact that the state advised prices have been maintained and not hiked, sentimental positive for sure. Does the math change dramatically?
Maths doesn't change dramatically for them because if you see the sugar prices somewhere or the other are taken into account of their mathematics already. The SAP not hiking and being flat, that gives a boost to margins a bit, but my only concern over there is if you're able to push out that volume again and whatever the China buying and everything gets executed. That's more important than the inventory which is sitting over there.
Yeah, but that would anyways be a case of how business changes. This is an incremental positive, no?
It might help out the margins, but the only point is how much can you push through into the raw material right now. Because you might have the old inventory sitting on your books. So that has to slowly get out of your books and the new inventory.
Which is priced at 26. The current price is at 31.5. So
yeah,
that's
so that's what I'm
positive.
saying. So somewhere it will benefit the margins, but the only point is will they take the whole benefit out of it? I don't think so.
Okay, got that. That's the sugar space. We'll see if any reactions come about in some of these stock prices. Anyways, a fairly volatile space. You've seen extreme price moves happening within this space on days of news. That's Bajaj Hindustan, 1 month session, Friday session as well. Friday session, most of them saw an uptick of about 1.5 to about 3% odd. Let's bring in Ruchit Jain, technical analyst at Angel Broking, who's joining us on the show right now. Ruchit, good morning to you. Making our approach towards 10,900 most likely at open will breach those levels. How are we positioning ourselves now?
Yeah, hi, very good morning to everyone. During last week, we had seen that the crucial resistance of 10,800 was crossed on the expiry day, and that resistance was crossed with a gap up opening. Usually we term such gap up openings wherein resistance gets crossed with gap as breakout gaps. And today now again looking at the global markets, even the SGX Nifty is hinting at another gap up opening. So after the breakout gap, when we see such further gaps, they are known as continuation gaps, and these gaps usually lead to the continuation of the trend which has been going on since last few days or since last few weeks. And already we have been seeing that the trend for the last few weeks is positive. So we expect this momentum to continue during this week as well. At current levels, even after a positive opening of 50-60 points, if we see, one can initiate fresh long positions over here. 10,765. Earlier 10,800 to 10,770 was the resistance. So on any pullback moves, now that becomes a crucial support. So 10,765 could be kept as a stop loss on existing longs as well as fresh longs if created in today's session. And on the higher side, the 61.8% retracement of this entire correction which we had seen in the month of September and October is placed somewhere between 11,050 to 11,100. So I think in this week itself we would see the continuation of the up move towards 11,100 levels. So certainly hold on to the existing longs, and even after opening one can create fresh longs for target of 11,100.
Okay, got that. That's on the index. Let's talk about specific stock ideas this morning. And Ruchit, what are you going to take your play on?
So one of the strategies now that we have been advising to our clients since last 2-3 weeks is to continue to trade with outperformers. Those stocks have been that have been going up in this up move. Continue to chase those stocks only. Pharma space, we have seen that in Friday's session from the support level we had seen a reversal pattern getting formed in the Nifty Pharma Index. Torrent Pharma is one of the stock within the pharma space which has been outperformer within this space. So we expect this momentum to continue since there is a breakout supported by good volumes as well. So Torrent Pharma could be bought around Friday's closing with stop below 1748, expecting target of 1845 in this week. And Bata, this has been one of the another mid cap name which has been showing outperformance in since last few months. On Friday's session we had seen that the consolidation resistances have been crossed with good volumes, so one can go long on Bata itself with stop below 1018, expecting 1088 target.
Okay, Got that. Those are some ideas coming in from Ruchit. But before I go across and get a few more chart checks from him, it's time now to move on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that Bloomberg Terminal has thrown up on a particular stock or a trend that he's picked up. What's on your radar today, Yash?
Morning, Devina. We are tracking BPCL on the charts today and a negative call coming in with the help of the bearish engulfing indicator. Let's try and first understand what it is. Basically, it's the formation of a bearish candle after a bullish candle, wherein the size of the bearish candle, which is the second candle, completely engulfs the one ahead of it, which in this case is happening on the charts of BPCL. So if we could get the chart back up again, you could see that as of the move of Friday, the bearish candle has completely engulfed the one ahead of it. And from what we understand is that for the last 3 days, the stock has been correcting and it has come under some bit of selling pressure. So going forward, we could expect that with crude oil prices also bouncing, a bit of a fundamental aspect there as well, BPCL could come under pressure, at least as far as today's day of trade is concerned.
All right, and how well has this worked in the past?
So, Devina, 5 out of the 7 times when the indicator turned negative, it would have given you positive returns on an average of close to 5% over the next trading session, next 10 trading sessions.
All right. Okay. Yash, thanks very much for that. That's a bearish engulfing pattern on BEML. I want to talk about Oil India. Now, Friday's session saw a big cut of about closer to 11 odd points given, 15 odd points given up. That's about 7.5 odd % in terms of the pricing activity. The previous day was the last day that you could own the stock in your account if you have to tender for a buyback. Now, obviously, with that gone, most of the selling came in the next day in anticipation of probably then buying back the stock at a later date at a fairly lucrative price, or at a lower price compared to the buyback price of 215. How do you do with an Oil India now, with crude oil scenario as well as now Friday's move in particular, probably primarily driven by buybacks and the buyback, and Thursday being the last day, and then Friday you come in and sell and hope to buy it at a lower price later on.
So I think 2 things happened to it on Friday. One was the crude really fell overnight again at 4.5–5%. So that gave the impact, and then the buyback, as you said, was another impact. So for us, crude is like a positive outlook. We see it around 85–90 coming back. Because the one issue major, which was the US inventories sitting on weekly, that might get sorted out by the truce the US and China gave on the G20 side. So I think over there, if they start consuming the inventory, then there'll be a big draw on the US number. So that would push the US crude prices even further. So we are positive on the Explorer side. It's a patience call. It will not happen overnight, because when the crude prices go up, they have the worry of the subsidies being shared by the government and the companies. So I think these 2 things are, if you take it into negative, and it's already in the price. So I think from here, if the crude moves up, and most likely it will, so I think this share will benefit, and it will go even further up than the buyback price.
All right. So crude Brent at $62 right now. You did see that uptick that came about of about 5 odd % on the back of Russia and Saudi Arabia stating that they are going to be looking at managing crude oil productions into 2019 as well. All eyes now on the OPEC meet on the 6th of December, whether or not they look at managing and there could be further production cuts or no. That's something that everyone's watching out for from that meeting. So in light of that, we had Brent crude in particular moving up closer to 5 odd %, 62.37.
Yeah.
Anything else, Samir, that you're looking out for, that's looking attractive to you right now, and that you're putting your money in, probably even averaging out some if you already held it before, or buying afresh?
So we're buying Motherson now. We've started on Friday. Because if you see, if US and China come to a more stable and much more rational talks, let's say in that certain sense, then the autos will be the first beneficiaries, and then the metals. So I think in the automotive, direct plays are very rare. So you have Tata Motors where you play through JLR, and these issues get resolved. And Motherson is the other big global component supplier, which is impacted by this tariff issue. And over there, I think the Motherson has taken a big knock on the valuations. Right now, it's trading around 25 times future. Its average is around 30-35 times on the future for past 5 years. So I think there's a big leg up. There might be another quarter or 2 quarters issue, but I think that's the place to even start looking and start buying over there.
Okay. You know what could also be interesting today are the aviation companies. ATF prices cut by 11% pan-India, and let's see if that has a bit of a bearing on some of the aviation companies in the session today. Indigo, Jet, SpiceJet, all of those could be in focus. Shrikant Chouhan, Senior VP for Technical Research at Kotak, joins us right now on the show. Shrikant, good having you. Thanks much for joining in. Are you looking up some of the aviation counters on your charts currently? And if there is a small uptick today, would you buy into them for a trade, any one of them for a trade?
Yeah, good morning, Neeraj. See, all these aviation companies have certainly bottomed out, because the way they have recovered from their lows and the way the crude prices have fallen. One thing is very clear, that they have seen their worst of last several months, and now they are reversing back. But while looking at the current retracement, all these companies are very close to their important resistance level. So it is better to take any buy call if there is any correction in these stocks. But Jet Airways certainly looks very promising bet with a short-term perspective, because the stock has formed some multi-bottom formation close to 300-295 levels, and from there it is reversing again and again. So here the stop loss level is very nearby. With the final stop loss at 290, we should look for adding long position in Jet Airways. And the way on that special day when the stock moved up with some million volumes, that day we feel that the stock has seen its, form its final bottom. So that was the average price was of that day was somewhere close to 302, 308 levels. So if you see the pattern of Jet Airways, it is continuously holding these levels. So it is heading for the levels of 355, 370, that's the view. So it's a buy, Jet Airways at current levels. But for Indigo, our view is that it is better to stay away for the time being, because it is retraced almost 300, 400 points from its recent lows.
You differ, Samir? Fundamentally, do you differ? It's okay to differ.
Yeah, because over there what will happen is Indigo, you see the cash flow generations are much better. So over there the consistency and the ATF benefits comes out more to Indigo, because they have new capacities added to the system. Jet on the other side is already facing flight cancellations. There are debt burdens, repayments. So I think from a fundamental point of view, I rather stay away from Jet and enter into Indigo.
Okay. What would you do with an emphasis? Is sudden interest coming back into the stock, or is this also just the fact that now 7th of December we have the buyback happening, so it's just the buying back of the stock to have it in your account?
So it's more led towards those technical issues and that technical date. Yeah. Because otherwise, if you see fundamentally, there's no reason to all of a sudden a spurt in the price or buying coming in. So I think fundamentally I'll stay away from it. If you want to invest in, otherwise it's more like a dividend income, because it's like a 4% kind of a market cap they're buying back. So that really doesn't entice me to even go for that buyback.
I thought the valuations seemed reasonably okay for Emphasis compared to the other mid-tier and IT companies
obviously,
too.
like we spoke with Deepak Shenoy, his take on the future buybacks, year-on-year buybacks till 2020, until Blackstone pays back that $500 million that they raised in the debt market.
Yeah, well, 1003, the last couple of days has been on a bit of a roll. Let's see if they continue. Shrikant Chouhan, a good time to probably get in your stock recommendations, the 2 stock ideas that you're giving. We'll take your index view in a bit, Shrikant. Your stock idea, Shrikant?
Oh yeah, Neeraj. See, for stocks, we are of the view that we should look for adding pharma stocks to our portfolio because they showed some renewed interest in the previous week. Lupin Laboratories, which closed at 885, 886, is showing a lot of strength on daily charts because it has broken its important resistance, which was around 880, 885 levels. It closed above those marks. So we feel that it is heading for at least 910, 915 in next 1 or 2 days of time. So it's a buy at this price with the final stop loss at 875. We also like other pharma companies which are like Dr. Reddy, Torrent Pharma, which are like not like frontline stocks, but which are part of the pharma pack. So there also a lot of interest is there. And from the auto space, we like TVS Motors. And the interesting part is that after almost 20-21 days, the stock has managed to close above
TVS Motors.
mark.
We'll come back, Shrikant, as to why you like that one. But pre-open on your screens right now. Gap up opening, at least on the pre-open, flattening out now. 0.25% on the Nifty, Sensex about 0.5%. Individual stocks and movements thereabouts. We'll come back to the index and get you, those prices once they start to consolidate closer to 907, 908. Yes Bank, once again, the top gainer on at least the pre-open tick. So a 3% bump up there for Yes Bank, 175 now for the counter. IndianOpen Bank is the other one that's up about 2.33%. Tata Steel, Hindalco, ONGC, JSW Steel has moved up 1.5%. You've got the likes of Bharti Airtel that's up 1.34%. Bharti Infratel is up. You've got Dr. Reddy's that's up 1%. Hindalco has moved up too. Vedanta has moved up about 1.5%. Asian Paints, Infosys, Dr. Reddy's, Tata Motors, TCS, 0.5% gain there. So just about 3 stocks in the red this morning, and one being Sun Pharma. That is showing you an initial price cut of 10%. GAIL and BPCL are the other 2 names that are looking slightly weak this morning. But for the currency, a slight amount of weakness has come back post the GDP numbers reported on Friday. Closed somewhere around 69.58. This morning has opened depreciated by 0.5%, 69.91.
Yeah, well, for now slightly weak, but let's wait and watch what happens there. The safe haven currencies too actually came a bit off, so don't quite understand this, but well, sharp pullback in the rupee already for the last few days, so maybe some bit of that being given away. Crude prices, by the way, mind you, have hardened a little bit in trade. Having said that, let's bring up the aviation counters. ATF prices have been cut. Do they react to that, or do they react to crude moving up 5%? That's the interesting bit. Let's see. Jet Airways, maybe a couple of percentage points higher. Interglobe Aviation and SpiceJet should also come up on your screen. Maybe start off well. Does a higher crude price kind of spoil the show today? Let's wait and watch. What's happening to Ramakrishna Forgings? Amansa may have sold, but Old Bridge Capital and Abacus, which is Sunil Singhania's fund, have bought into Ramakrishna Forgings. Let's see if that is reacting. No major reactions. Let's see if sugar is reacting at all. Bajaj Hindustan, Balrampur, Dhampur, the UP-based sugar mills. Balrampur not so much. Dhampur and Bajaj Hindustan a bit illiquid. So no big reactions that are coming in the sugar pocket in the session today. Very, very muted. So small benefit. Samir Kalra was right. Maybe a small benefit, not being bought into in a meaningful way. For now, the rates that are looking very strong are likes of KRBL, Gulf Oil, Prestige Estates, etc. Let's see if these stocks react majorly or do they cool off a bit. And do watch out for Repco Home Finance and EHFL. They were big movers in Friday's session. Let's see if there's a further reaction into all of these names or no. No, not quite. Just about muted really for the broader market stocks. It's quiet as she goes. Nomura has upgraded the tire counters. Let's wait and watch if those stocks are reacting in today's session or no. Well, marginal reactions into some of the tire companies as well. So those are 3 or 4 names that you should watch out for. TV today has an 11% uptick. Let's wait and watch if she lasts. But the index likely to start off about 10,933. Shrikant, Chouhan, would you go out and buy the index this morning?
See, Neeraj, already the market is opening up with a gap of 50-60 points, and if we go through with its previous trend, then it was around 10,490 on last Monday. Currently, it is at 10,000. 950, 960 kind of levels. So we are very close to psychological mark of 11,000, and here we are expecting some profit taking or reduction in long positions. So it is better to take some contra call of going short between 10,950 and 11,000 with a final stop loss at 11,050 on the high side. Buying is not advisable, but yes, in case if we see any drop during this week close to 10,800 or 750, then there certainly we should look for adding long positions, because now 10,700, 750, it's certainly going to act as a very good support for the market. There the market is having support of 200 days simple moving average, as well as the market has spent a lot of time close to those levels. So 10,800, 750 is the area of buying. There if we see any drop, buy. And in today's date, take a contra bet of going short between 10,950, 10,975.
Okay. What's moving around? Well, Devina spoke about Yes Bank as one. Sun Pharma is the other one on those news reports of the insider trading case being reopened. 6.5%, the likely opening reaction. This may change, of course, but will have some weakness. Sun Pharma Advanced Research is the other one, which is opening up about a couple of percentage points lower as well. Samir Kalra, what do you make of this news, the impact on Sun Pharma, and what would you do with Sun Pharma?
So I think it's an opportunity for investors. If you see, there might be, these corporate governance issues coming up here and there when the markets are into a bear or a panic mode, or it's becoming a trend now. If you see on the corporate governance end of the stock. But if you see remove that and see the company, now the specialty drugs are getting approval day by day, and the US FDA issues are almost through. So they are getting only pre-approval inspections done, which is a better thing for them. So I'm looking for next 3 years. I'm not looking for next 6 months or 9 months from here. So whatever I've reduced at a higher price on the weight, I would like to buy at a lower price and see this panic play out.
So buy at 465, which is likely the price?
460, 440, around that. That has been the lowest in the recent times.
So you're accumulating that back?
Yeah. So you'll start to buy or accumulate to a certain extent.
Okay. That's Sun Pharma there, and Samir believes this to be an opportunity if you can ride out this current phase of panic selling on the stock. 465 on Sun Pharma. Some of the steel names today are active, and they have been over the last few days as well. So the likes of JSPL, SAIL, JSW Steel, are up anywhere between 2.5% this morning. What would you do, Ruchit, for steel?
I think some of the names from this sector should show some positive momentum in next 2-3 trading sessions. Specifically, if I say the specific names, then Hindalco is one of the stock which has taken support near 210, 212, and since last 3 months, I think it's been 4 or 5 occasions where this range of 210 to 12 has acted as a support. So which should see a bounce back towards 240 to 42 kind of range in Hindalco. And NMDC is one stock where one can take a counter trade over here, because recently we had seen a sharp sell-off in NMDC from levels of around 115 to around 95 now. Now, if I look at the monthly or the weekly charts, then this range around 95 is a very crucial support from a medium to long-term perspective. And on the weekly chart, the stock has also formed a reversal pattern during last week. So a pullback move in NMDC should be expected towards level of 108 from a short-term perspective. So one can go long on NMDC with stop below 91 for target around 108.
Okay. Few other names then to this morning at pre-open at least. The likes of Alembic Pharma, that's up 2%. RBL Banks up 1.8%. Adani Power up 1.5%, and Apollo Tyres 1.5% higher. Samir, power as a trade right now, specific to Adani Power and the likes of Tata Power. I mean, you're obviously waiting for more clarity with regards to the Supreme Court decision, but nonetheless, these stocks have been fairly active. Last 7 days, you've got an Adani Power giving you returns of 21%.
Yeah.
How would you position yourself?
So I would stay away, because being an investor, I don't want to have where the high debt is there, regulatory issues are there. Then my revenue generation is dependent on the approval of the state. So over there, I like to stay away, because my debt repayments are not dependent on the regulatory issues, and they are consistent. So they have piled up a lot of losses in past couple of 3 years or 5 years. So over there, if they get some kind of a relief from Supreme Court, it might give you a bump up for 2-3 months. But as a long-term bet or a long-term industry where I see benefits coming out, I don't see that, because it's more of thermal is going out of the sense, and now solar is there, which is getting cheaper day by day. So it's more of consumer benefit industry rather than the company benefit industry.
Right.
Okay. Devina, Sun Pharma looks like as the pre-open it's settled down, starting off 8.5% lower at 450. Ruchit, a quick thought, 30 seconds. What do you do with the Sun Pharma?
I would wait for at least initial half an hour of trade, Neeraj, because if I see the long-term charts, and the support is around 440. So if we see any kind of pullback moves post this huge gap down opening, and if we break the first half an hour highs, then only I would take a contra call and take a buy trade with stop below 440 or 435.
Okay. Jain, stay on. Lots more to talk about. We'll let's quickly tell you all that you need to know to stay ahead in trade today. First up, equities, metals and crude prices rally on news. The G20 meet in Buenos Aires, Argentina. US-China have agreed to a temporary truce to contain the trade war. No new tariff scare for a period of 90 days at least.
November auto sales numbers show strong traction as Maruti Suzuki, M&M and Hero MotoCorp surpass estimates, while Tata Motors stays behind in the race.
SEBI has reopened the insider trading case against Sun Pharma, according to a PTI report. UBS says it could take some time to resolve, and in the meantime, the stock may witness a valuation discount relative to its large cap peers, likely to start off 8.5% lower.
There's another piece of news from the pharma space that you need to know. Fulphila, the cancer treatment drug that Biocon jointly developed with Mylan, has received marketing authorization from the European Commission.
On to some bulk deals now. DSP BlackRock, Fidelity Funds and RWC Global were all bulk buyers in ICICI Lombard, while Amanza has sold 5.2% stake in Ramkrishna Forgings.
Lastly, we bring your attention to some key brokerage calls for the day. Nomura has initiated coverage on the tyre sector. It has set price target on Apollo Tyres as 288 rupees per share. For Sia Tyre at 1,346 rupees per share, and for Balkrishna Industries at 1,008 rupees per share.
Okay. Samir, before we let you go, Prestige Estates, any thoughts? It's been active the last few days.
No, I don't cover it that actively, but whatever I know of it, it's more into the commercial space, and it's getting benefit of being over there. And the residential book is heavily dated. So I think I'll stay away from the real estate as of now.
Okay. Leave it at that. Samir, thanks so much for taking the time out and being with us today. I really appreciate your time. Watch out for Prestige Estates. That stock looks like starting off reasonably okay today. Watch out for some of the commodity names, the likes of Vedanta, Hindalco, etc. They too look like starting off well in the session today. 3 minutes left for the markets to kickstart trade. Let's get in. Mukul Kochhar, he's head of institutional sales at Investec, joins us right now on the show. Mukul, good having you. Thanks much for joining in. We'll talk about the market view in a bit, but the big news for the morning seems to be on Sun Pharma. What is it that was discussed in the morning meeting as regards to this news? What will you tell your top institutional clients to do with Sun Pharma today?
So, while there's a lot of news flow around corporate governance in Sun Pharma, that is what is causing the immediate compression in the stock price. We will let SEBI lead that investigation, and honestly, there's not much any broker can comment on that. Fundamentally, though, on the pharma business, we've been fairly negative overall on the sector, including on Sun Pharma, and that is partly the reason why the stock's not holding up well, because the base business itself is weak and the stock is expensive as far as the base business is priced in. For a lot of these companies that depend upon single product successes for its earnings, this is sort of a comeuppance, because over the next 2-3 years, you should see some of these single product earnings sort of dissipate. And right now, the market is giving a multiple in perpetuity to these earnings. So that itself should correct. So corporate governance concerns aside, we've always thought that the stock's expensive for the kind of earnings it can deliver in the near term.
Okay, that's Sun Pharma there. Now at 450, nearing the close of the pre-open session and making its approach towards opening. A minute and a half left to go for markets to open. Just get some of the top trading ideas going from both our technical analysts, Ruchit as well as Shrikant. I'll start off with you, Ruchit. What are you liking for this morning's trade in particular?
I think for an intraday session, metals should see some positive momentum because most of the metal names are indicating a gap up opening today. So NMDC, which I spoke about some time ago, I would recommend it for intraday also. One can go long at current levels of around 96.50 with stop loss below 94 rupees, expecting target somewhere around 99 rupees.
What about you? Your top call for the day?
See, I would like to go with TVS Motors, which is around 557, 558 levels, and as I mentioned, it is into breakout mode, so it is heading for the levels of at least 585, 590. Stop loss level is very nearby. 590 should be the stop loss for any creating short long positions on TVS Motors.
Okay. To watch out for these two names. These are the top ideas from our experts. Stay on, gentlemen. We'll talk more about some specific charts as well. And what could happen in the near term. We look like starting off on a positive note today, so expect the Nifty and the Nifty Bank as well as the Sensex, of course, to start off on a positive note. The question mark only is whether we can live up to the optimism or whether we'll cool off after that initial hurrah that we'll see at the start on our markets. Remember, 5 straight days of gains already. Let's see if there is a 6th one in store today. But the start is positive, 0.5% as the pre-open rates were suggesting, naturally so. The mid caps and the small caps will also come up on your screen, and let's see if there is strength out there at the broader end of the spectrum. The mid caps certainly so. The small caps to 0.33%, not bad. Remember, Friday's session was the first time we saw positive market breadth for our markets in the last 4 or 5 sessions. However, let's bring up the heat map and see what's moving and what's not. Sun Pharma should be right down here, 9.5% lower. So Sun Pharma clearly bearing the brunt of this news reports about the reopening of the investigation. Oil marketing companies, primarily because of crude prices moving up 5%. The last time we saw NYMEX up in trade, and that's a result, I believe, that's the reason why these stocks are doing what they're doing. But clearly, Sun Pharma is the principal culprit in the session today. But a lot of green on the screen. Let's talk about the gainers too. Commodity names doing very well. All 4 top gainers are commodity names: Tata Steel, Vedanta, Hindalco, and JSW Steel. So good start. IT has a mixed bag today, but Infosys is marginally in the green. HDFC continues on its merry way, so doing okay for itself. A lot of heavyweights in the green, which is essentially helping the markets stay about 0.5% or 0.7% in the green. Let's talk about a couple of pockets of strength or weakness, and let's just see what's happening here. There are 2 or 3 areas that I want to highlight. Firstly, the state advised prices for sugarcane in Uttar Pradesh have not been raised, and I think that's a net positive for almost all of these companies. So Dhampur about 1.5% higher, Dwarikesh about 1.5%, Balrampur just about 0.5%, 101. So interesting moves for the sugar names. Not a big reaction, but a reaction nevertheless. What about some of the other newsmakers? The ATF prices have been cut, but a tempered move, I reckon, because crude prices have moved up a bit, but nevertheless about 0.5% to 1% a piece for each of these names. And then watch out for some of the NBFC names. They could be active today as well after Friday's move. But Devina, are you spotting that, or is it what else are you spotting?
Well, from the mid-cap space, NNIT Limited, that's up about 5% right now, 4.5% at 83. Unitech has moved up 2.5%. You've got a Syngene that's up 2%. Deepak Fertilizers 1.8% higher. RPL Bank, that's been making a move this month, is up 2. You've got Chambal Fertilizers and some of the other names there in the fertilizer space which are looking extremely active. Likes of a BEML, that's higher in trade today. Adani Enterprises, and we've been talking a lot about this one. Last 7 days moved 3.5% higher. TTK Prestige is up. You've got Praj Industries that's moving up as well. But the likes of a Sterlite Tech, a Suvan Life, Firso Solutions are some of the gainers within the mid-cap space. Amongst the losers, a JM Financial, that one is down about at 84. That's 4.5% given up. Century Ply, Wellspun India, Allahabad Bank, Chennai Petro, and Divi's Lab are some of the losers in trade this morning.
Well, interesting. Before we get back to Mukul, Kochhar, just quick opening thoughts from our experts. Shrikant, to you, any of the commodity names that look good for a trade? All of them have started off well, without exception.
Yeah, like Tata Steel, Hindalco, they did really well. But we also like Vedanta, which is around 203, 204 levels. And if you go through with its weekly formation, then one thing is very clear that the stock has completed its 3-leg downward move and now is ready to move towards its next levels of 225, 230. So with a short-term perspective also, it's a buy because the stop loss level is very nearby. With the stop loss at 195, we should look for adding long positions on Vedanta. But with a positional view, with a medium-term view also, we can initiate long positions and we can keep target somewhere close to 220, 225. Apart from this, few pharma companies like Cipla, Aurobindo Pharma, they open higher, and there we are expecting some more activity.
Okay. Sun Pharma is the big loser for the morning. You already taken a fundamental view. Ruchit, before we thank you, I know we've taken a technical view already, but because it's open a lot lower than what was anticipated earlier, what do you do now, if anything?
So Neeraj, if I see some of the long-term supports, then 435 to 440 is a good support for the stock. So until that is breached, and in case if we see a recovery today and the stock crosses the high of around 458, then it could become a good 459, then it could become a buy for an intraday as well as short term. So wait for a move above 459. If that is crossed, then only look to enter Sun Pharma, otherwise tend to avoid it.
Okay. That's Sun Pharma. Thanks a lot, Shrikant as well as Ruchit, both of you, for staying back and highlighting all of those queries as well as giving us your picks for the day. Mukul, good morning to you. You know, we were earlier on having a discussion about the private sector banks and the recovery that we've seen in most of them in the month of November. Is that likely? You know, do you feel that this move that they've seen have legs to take it up further, considering the valuations from where all of them have started to bounce back, and stocks like an ICICI Bank, Axis Bank and the HDFC twins, they've been favorites and most likely will remain. What's your sense on how to accumulate and probably add these stocks to the portfolio?
So the private banking trade remains, and it's very strong. If you look at what is happening in the sector, you know, post Yes Bank, what's happened, you know, honestly, it's a little unfortunate as well, but you will see capital or equity capital gravitate more towards the larger, more stable names. So in the years forward, you should see the large 3 or 4 banks with good retail franchises consolidate the sector, even of their large bases, take market share. So this trade is remains. I mean, so the banks that we like in the large banking space is ICICI Bank, HDFC Bank, and Kotak Mahindra Bank. So all three, I think, you know, are positioned to do better than the sector as well as the market. So that trade remains. The second thing that has emerged in the financial space is the possibility post the crude correction that you could get easier monetary policy. And, you know, once again, so the quality NBFCs would be direct beneficiaries, but they're not really cheap today. They have bounced back. We would gravitate towards, you know, small finance banks like Equitas, or even something like a DCB Bank, which is a quasi-NBFC, but a bank which allows stable regulation. Regulatory risk from RBI is minimal because they're already regulated by the RBI. So, you know, per se, if you want to play an era of oncoming easy liquidity, you can even think of quasi-NBFCs, small banks like DCB Bank and Equitas.
Okay. Mukul, the other set of stocks that could potentially benefit, I mean, today we are seeing that bit of a move upwards, but whether or not it is sustainable is the question that I'm posing to you, which is the commodity space. Now, has weathered a bit of storm of late. If indeed the trade tensions are diffusing, is it a net positive for the global economy and therefore a net positive for some of the base metal names?
So commodities are always a trade, and one should always remember that. I mean, these are not multi-year hold stocks. You buy them when they're cheap at the bottom of the cycle, and you play for a reasonable trade, and then you get out. At this point, you know, the earnings are strong. Based on those strong earnings, stocks are cheap. So I would, and they're getting upgraded. So I would probably still stay invested, but honestly, the trade is not that much out here anymore. Which is remaining, but the one stock that we like here is Tata Steel, which is trading at roughly 4.5 times EV/EBITDA. If you consider the value of the acquisitions that they've made and the earnings that they can generate from them, so selectively you can still buy, but remember these are not buy and hold stocks. So there's nothing structural here; these are still trades.
Okay, the interesting bit, Mukul, is what would what would an institutional house tell its clients to do with the oil marketing companies? Crude certainly way off the highs, but with what's happened in G20 and what could happen in OPEC, maybe some upsides here. Is there, however, a net positive view on the oil marketing companies because of the over 25% fall from the recent peaks for crude, or would you be circumspect?
So actually, we don't cover the sector, so I'll skip comments on this.
Okay. Anything crude related that you would have a view on? Maybe aviation, maybe the upstream names, if not the oil marketing companies?
So honestly, crude has an indirect impact on the entire market. I can just say that falling crude in the near term means that CAD is now below 2% for 2019. This is roughly offset by incoming FDI. So CAD plus FDI, we are net neutral. So while not a completely comfortable situation, it is much better than where we were 5-6 months back. So that itself should beget a rally in domestic stocks because inflation is contained. You should see lower inflation. So honestly, falling crude has an impact on almost everything in India. So while direct impact, one sector that you can think of in terms of direct impact is cement. So crude and derivatives, energy derivatives like petcoke, coal, a correction in that, which is a major input into cement production, that itself can aid margin in the near term. So cement is one sector that one can play where over the years profitability has under-delivered, and if margin sort of picks up, one could see a rally in cement stocks. But overall, I mean, falling crude is positive for most of the domestic stocks in the country.
Right. Mukul, one last question from me regarding the auto sales numbers that we've been seeing, and disappointing yet again for some of the names there, though the big banking now is on how the tractor sector does and whether or not that's an area to keep an eye out for. How would you play the auto space?
Honestly, one has to look at longer term trends. Wherever data points are monthly, one has to sort of smoothen them out and not get too carried away by monthly numbers, because you will get periods of slow growth as well as high growth. Having said that, there is enough opportunities to stock pick in the sector. Passenger car penetration in the country is extremely low. There is no way but up, despite the fact that you may get a few months of air pocket where growth is tepid. So Maruti is a play on long-term growth there. Even if they lose a little bit of market share every year, I mean, the stock is still capable of delivering roughly 15% earnings growth. For that, the stock's not that expensive. The second stock that one can think about is Bajaj Auto, which has been gaining market share within the two-wheeler space, posting very, very good numbers. Margins are bottoming. We should see some margin expansion as well over there. And honestly, these are air pockets which has in two-wheelers resulted from a sudden announcement of purchasing upfront insurance, which is a burden for buyers upfront, but this should anniversary. And for passenger cars, it's a little bit of fuel price hike, extra excess inventory, but all these are transitional. I mean, if you look longer term, there's still stock picking opportunity, and we like Bajaj Auto and Maruti here.
Okay. One final question from my end, Mukul, and that's on telecom. The last few sessions, it's looking like Reliance is kind of weaning away market share, revenue market share, etc., from the incumbents. I mean, if I can call Vodafone Idea and Bharti incumbents. What's the view on those two names, though, and Vodafone Idea in particular? As a house, do you have coverage there?
No, we don't, but I can give you broad comments there. So this sort of a price war where everybody's balance sheet is under strain, including Reliance. I mean, if you actually look at the numbers, is not sustainable, right? So even the government is chipping in. If you read the news flow, the government is encouraging them to raise prices. So there could be, honestly, some action on predatory pricing also out here. So I think there's a fair trade to say that one can expect ARPUs in the sector to go up from here to make the sector sustainable. Remember, telecom is a core infrastructure service in the country. So honestly, the government at some point will intervene. Right now, it's a soft signal, but they may jump in with more gusto if things start getting worse. So yeah, there is an opportunity to bottom fish out here in the sector.
Okay. Mukul, we'll leave it at that. Thank you so much for taking the time out and speaking to us at Bloomberg Quint today. Look forward to have you more often on this forum.
Thanks. Yeah, bye.
Well, on expected lines, the equity markets have cooled off a little bit. The Nifty Bank is absolutely flat, and the Nifty 2 just about 26 points higher. So a bit of a cool off from the highs of the day. Sun Pharma leading the charge on the downside, but the oil marketing companies too following suit. Well, not the best of starts, I must say. Let's see if we build on from here, though. Let's take a break. On the other side of the break, though, government mulls the merger of REC and PFC to plug the fiscal gap. The stocks got decimated last week. We speak to REC chairman PV Ramesh about the proposed deal, and then decode the 6 drivers for the Indian banks that Moody's has outlined in its report with Shrikant Vadlamani. Stay tuned to Bloomberg Quint.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back. You're watching Indian Open. The government's been working on a plan to merge the two state-run project finances, REC and PFC. The plan is to get REC to buy a majority stake in PFC while it helps the government inch closer to its divestment target. It also consolidates all the debt in one place. Joining us now to talk about the merger in greater detail is Mr. PV Ramesh, the CMD of REC. Whether or not this is actually something that's on the table for them is something that we are very interested to know. Mr. Ramesh, thanks very much for joining in. First off, can you clarify for us what are the plans regarding the merger of REC and PFC?
Let me clarify that we have neither information or knowledge about what is being talked about in the media. And I think there has been a lot of avoidable conversation regarding the acquisition and merger. Let me also clarify that both PFC and REC are major power financing companies. They are proactively involved in execution and coordination of flagship programs of the government. They are listed companies. They are actively involved with the major nation building programs of the government. So and obviously they are the government is the major shareholder of both the companies. So whatever decision the government is to make would be in the larger interests of the shareholders and also in the interests of the national development and the company. But let me clarify that we have no information or knowledge, and so this is mere speculation, and I would not like to speculate on what could happen and would happen. We are prepared for whatever decision that the government takes. We are focused on our work. Our work is principally on ensuring that we meet the requirements of the power sector as the demands grow, but from across the value chain. And much more importantly is to complete electrification of all households in the country under Saubhagya. We are fully engaged with that program, which is the principal driver at this moment of the government and of the states as well as REC.
Right. So has REC in any way expressed any sort of concern with just acquiring a controlling stake and not having a merger instead, in the backdrop that, just a stake buyout will lead to a weakened credit profile without any operational benefits?
No, I have no information. We have received no communication. We are not engaged with that process. It is highly a speculative process, which I have been reading as well in the media.
Right, sir. Sir, I'm just probing a little bit more, but in the event that the merger does take place, could you highlight the synergies that would come about with this merger?
That's a purely conjunctive, that's purely a conjuncture, and that's a speculation that I won't like to indulge in. However, just to simplify the matters, particularly for those who relish in speculation, both REC and PFC, as I said, they occupy the same space. They are both active in the power financing company. They are almost about the same size, and it certainly is a value there are huge synergies in terms of the operations, the skill set, the competencies, the market exposure. So they are essentially templates with certain minor variations. You would have a much, and the power sector is fast growing enterprise. The power sector is the major driver of the economy, as well as the economy demands further growth of the power sector. So this is a virtuous cycle. And this virtuous cycle, and as the economy is on a fast growing track, and particularly with the massive investment that government is making in strengthening the distribution infrastructure and transmission infrastructure through various programs, a reform through Deen Dayal Upadhyaya, through Saubhagya, through Integrated Power Development Scheme, and also reform of the DISCOMs through the Ujjwal DISCOM Assurance Yojana. There would be more and more demand for investment in strengthening the power infrastructure and also to meet the ambitious target of the government to add 175 gigawatts of additional generation capacity in the green energy segment by 2022 or even earlier. There would be large investments that would be required across the power value chain, and a larger enterprise would certainly have a much higher value for the shareholders if that were to happen.
Right. Okay, got that, sir. So, in the past, when we're talking about the consolidation effort by the government, a time when ONGC picked up stake in HPCL, shareholder value has been eroded since then. Shareholders of both REC and PFC would already have witnessed that in the last few trading sessions. What will all this mean from a shareholder point of view?
Let me clarify. I think these are completely different segments altogether. I'm just speaking out of turn because as the ONGC, HPCL, I'm sure the government has taken a conscious decision. However, they occupy different segments of the value chain. We occupy, the PFC and REC occupy their templates. They occupy the same segment in the power financing segment. So we do the same job essentially. Maybe REC does a little more and PFC does a little more in the urban areas. We do a lot more in the rural areas. However, there are a lot of synergies between us. I mean, it's a perfect template for integration. However, it's the government's decision. I wouldn't like to speculate on that grounds. I can assure the shareholders, particularly my shareholders, that whatever the government does would be in the larger interests of value protection and value enhancement, and the shareholder value enhancement, and certainly it would have a much better returns for the shareholders, and we will ensure that, and that's why we are here.
Okay, got that. So in the event of the merger, will the combined entity be better placed to borrow at lower rates and help fund the nation's goal of affordable electricity to all, and find bigger and better projects to fund as well?
No, I mean, at one side we are jumping the gun here, we are presuming certain things, but let me say this, having said that, let me also say that the government of India has committed itself to providing reliable quality power to all citizens in the shortest possible time. The Uday has, which is a tripartite agreement between the central government, state government and the distribution companies, have committed, made certain commitments where the DISCOMs have committed themselves to ensure power for all citizens within the shortest possible time. And the government of India has provided nearly 1,30,000 crore as grant to strengthening of this delivery system through Deen Dayal Upadhyaya Gram Jyoti Yojana, through Saubhagya, through IPDS, and this includes modernization of the distribution network as well as electrification of every single household in the country. So this is a very far-reaching intervention in terms of actual infrastructure strengthening, and this is coupled with reform in the reform of the distribution companies in terms of the operational efficiency, reducing AT&C losses, reducing the cost of purchase of power, increasing the billing efficiency, increasing the revenue recovery. So a whole host of transformational opportunities that the government has introduced, and this is contributing a rapid acceleration in terms of the power sector being transformed across the value chain. This includes the addition of green power, this addition of the modernization of the existing thermal power stations to comply with the Paris Agreement, and then creating a national grid and delivering quality power. All this requires massive investment. The CEA estimates that it would require nearly 18 lakh crores in the next 10 years on the generation segment alone to meet the growing needs of the country, and perhaps an equal amount in the transmission and distribution segment. And all this does require large quantities of financing at a fairly competitive rates, duly raising resources both in the domestic and the international market, so that the power sector wheels will continue to move at an accelerated pace, so that every citizen of this country is not only provided quality power, but also the industries, the commercial establishments, and the rural agriculture consumers are provided assured quality power round the clock. So power sector in India would continue to grow, considering the fact that our per capita consumption is still among the lowest, and there's a huge potential for growth. I would like to believe that the power sector would continue to accelerate, and we have seen that. I mean, the month on month, the demand for power has increased by about in double digits. They have 10.5%, and compared to last year, there is the demand has increased by about 10,000 megawatts, and an addition of another 3 crore households to the whole distribution network is likely to increase the demand by another 18 to 20,000 megawatts. So all this is, I mean, this is just sheer domestic consumption. Now, its ancillary developments would mean further demand for power. So we are seeing a transformational moment in the power sector, and this is a transformation that is likely to sustain for a long time to come. And obviously, financing powers would continue to be a major requirement and opportunity for companies like REC and PFC.
Right, sir. So what I'm understanding and what you're saying probably indirectly, not directly, is that there is a need for a big power lender to come in and fund these growing power requirements in the country?
Maybe. And we are fine as we are. If we were to be merged, that would be fine as well.
All right. So just one last question, status of your stressed assets, and of the 14% exposure that you have to the private sector, 60% already non-performing. Any further slippages expected, and any out of NCLT resolutions?
First, let me clarify that REC has the best asset quality among its peers. 86% of our loan book is exposed to the state enterprises where there is absolutely no stress. The stress exists only in the private sector, and even that is in the thermal, coal-fired thermal power stations. So we have already made, we have followed the 12th February circular of Reserve Bank of India, considering that we are part of a consortium with the banks, though as an NBFC we are not mandated to make to classify them accordingly. We have adopted the IND AS, the Indian Accounting Standards, effective 1st of April, by which we have got all the assets assessed at fair value through 2 independent agencies, and then have made provisioning based on the credit impairment assessment. So we have made provisioning to the tune of almost half of the stressed asset value. We are now seeing a positive resolution. 4 of those assets which were classified as NPAs, which were credit impaired, or now have since become or in the path to become standard. We are hopeful by end of this financial year they would all become standard. We have Lanco Anpara, which is a major thermal project in Uttar Pradesh, which is since a litigation had since been resolved. There is a SR transmission company has been commissioned. There are 2 hydro projects, Gati and Dance Energy, which now have a PPA and they are generating revenues. All these are on the path to become standard, and we do not, so which basically means we do not foresee any slippages. We have seen the summit of stress. We have now likely to become likely to reverse in the coming months. Our net NPAs are about 4.2%, which is the lowest in the league. We will continue to, and this has come down from 5.6 to 4.2, and we are likely to become improve in the days ahead. With regard to the major assets where we are working with the other banks and the financial institutions, at least 2 to 3 of them should see resolution in the next few months. We have already given our consent. We do believe that those must find an optimal resolution in the days going forward.
Got that, Mr. P.V. Ramesh. It's a pleasure chatting with you. Thanks so very much for coming on board and clarifying all those details for us. That is the management at REC. So at this point, not received any sort of a communication regarding the merger, but they're open to it.
Interesting. The stock is recovering a little bit after the slam dunk that those stocks have seen the last few days, the whole of last week, in fact. Moving on to the next piece, trying times for the Indian banking sector, elevated stress levels, tougher regulations and greater scrutiny. While retail-focused banks have fared slightly better, the corporate-facing lenders have borne the brunt of pain. But rating agency Moody's seals a silver lining. The international rating house says Indian banks are stable. Joining us now to tell us what's convinced Moody's that the macro factors won't turn worse is one of the authors of the report, Shrikant. He's Vice President, Financial Institutions, who joins us on the phone line from Singapore. Shrikant, good having you. Thanks much for joining in. Is this outlook of stability on the strength of the economy and a steady asset quality, is it across the board, or are you seeing this only in parts and only in the larger banks?
Sure. So when you look at a title, right, it says on the basis of a good economy and a stable but weak asset quality. So in fact, that in sense captures what we are trying to say. So we are saying it is stabilizing, so things are not getting worsened, but it is stabilizing at a relatively low level as far as absolute levels are concerned. So given that the credit profiles of the Indian banks, particularly the Indian public sector banks, on a standalone basis are already at a relatively low level, that is basically the driver for stability. And even in terms of operating metrics, we are not expecting a worsening. So from an asset quality perspective, we think we are past the peak as far as the recognition is concerned. At the same time, the NPL ratios on an absolute level, as you would know, are quite weak. So we are not really expecting a V-shaped recovery, but it will sort of stabilize at current levels.
Interesting. Shrikant, equity markets by nature tend to think a lot more ahead than what they probably should. Rating agencies, rightfully so, take a look at all the data and then, give a call. My question is, this time around, there's a bit of a convergence in that I hear a lot of large investors talking about how Q4 of the current financial year onwards, you will see a bit of a recovery in the asset quality and the growth numbers for the PSU banks and the corporate-facing banks. Your answer and your report seems to suggest that you believe that would be the case as well. If not Q4, then at least in the next financial year.
Yeah, I mean, we can't take any view on the timing per se because, especially on the corporate NPL side, the prognosis tests on two hypotheses. One is the fact that there will be recoveries that will happen. But while the IBC has helped to have a relatively shorter time frame, it is obviously not happening in line with what was enshrined in the IBC law of the 180 days or the 270 days. So we can't really have a view on the timing, but recoveries definitely will have a potential for surprising and positive. The second one, again, because of which we can't really comment on the timing, is on the power sector, which is, I think, from the entire corporate asset quality puzzle, the missing piece, if I can put it that way. So in the power sector, as far as recognition is concerned, we are not expecting any surprises. So we think all the bad apples have been already identified. The issue is really in terms of what is the haircuts that have to be taken, and the visibility on that is not very high. So that is again one more parameter which it's very difficult to put a time frame on whether it will happen in the next 2 quarters or a bit beyond that. But that again would be one of the factors that will determine the extent of the recovery.
About the growth aspect, Shrikant, hitherto the last 4 years we've seen NBFCs capture a larger share of the growth from the corporate-facing bank, or actually the PSU banks, to be really honest. Do you see that tide reversing in favor of the PSUs and the corporate-facing banks?
Sure. Again, I think I would rather not look at it as NBFCs versus banks. I would rather look at it from a segment perspective. So over the last 5 years, what has happened is that the retail segment has grown much faster than the corporate loan segment, irrespective of which are we talking about NBFCs or banks. Because for that matter, even public sector banks, those who are under PCA and obviously are facing obvious growth constraints, even if you look at their own loan books, the retail growth has been relatively good. I think all of them are at least going at least in the double digits. So it was really a question of retail versus corporates. Of course, there's no denying the fact that even within retail, some banks and some NBFCs were growing much faster than the other banks. And that was in part driven by because of the capital constraints that some of the public sector banks were facing. So it's really from that perspective. And if we take it from that perspective, the way we look at it is that the key benefit to the banking sector will not really come from market share gains as much as it will come from greater pricing power. So especially in segments like lab, where pricing pricing was on a downturn because everybody wanted to lend to the sector. In that sector, for instance, there is a very high probability that credit conditions will tighten. There is no availability. We don't expect the banks to really step on the accelerator and say that we will supply all the credit that hitherto was being supplied by the NBFCs. Rather, I think what will happen is that they'll use this to leverage upon their pricing power. So banks will benefit, but the channel probably is the pricing power rather than the volume channel.
Interesting. One of the pointers that I believe you've put out on your report is the risk, and which is that rising interest rates represent a bit of a risk. Now, the question mark only is the extent of rates rising, and I don't know if you guys look that much far out or no, but if the Indian inflation numbers for India are anything to be believed, or the Fed's comments recently are to be believed, the pace of rate hikes and the quantum at that too might not be as high as what was believed maybe 6 months ago. How does this piece of the puzzle fit in?
Well, it is positive in that respect that the base level of interest rates maybe they may not, if the factors that you said pan out, then the base level of interest rates will not rise that much. But I think what is also probably equally interesting is how the rate hikes will transmit through the various channels. For instance, going back to my previous argument, on the retail side, in effect, because of this entire NBFC crisis, there has been in effect rate hike. Because we have seen, for example, NBFCs hiking rates because they can't supply the credit. We would expect banks also to hike up their rates. So while the base level of rates may not have increased, for certain segments, the spread will increase, which has the same effect on growth as it would have been if it was just a plain rate hike across the sector. So the impact would be sort of a differential impact, and certain segments which are going faster will see a slowdown, and the channel will be through the fact that the cost of credit will increase, irrespective of whether the base level of rates go up or not.
Interesting. Okay, Shrikant, we'll leave it at that. Thank you so much for taking the time out and joining us on such short notice. Really appreciate it.
Thank you.
Well, that's the view from Moody's on Indian banks, and they're not bifurcating between banks versus NBFCs. They believe, by and large, the troubled space, which is the PSU banks and select corporate-facing banks, have a higher probability of growth and asset quality returning to stability and growth in the near term. Timing is something that they will not be able to comment on, actually. So the markets, as we speak, about 0.5%, and the Nifty Bank too is recovered after just touching the even-Steven levels, about 0.25% higher, but nothing to write home about.
Yeah, that's the Nifty for you, still holding on to 10,900. But with that, it's a wrap on this edition of Indian Open. Thanks a lot for watching. All the market action continues on the FNO Show.